This is the weekly economic and market report for the week ending September 2nd. I look forward to September 6th. My personal sentiment has changed a little bit. If we look at the short term, which is now instead of up to 5 months from now, I'm looking towards the end of the year where my sentiment will turn more bearish. But I've come down a little bit. I'm 65% bullish, 35% bearish. Midterm, 4 to 10 months, I'm 30% bullish, 70% bearish, 0% neutral, and long term, 100% bearish. Now, I'm going to make the mention again, if you've watched some of the videos, of some tools that I use in this particular scenario where I'm really not neutral at all about where the market's going. And that means that I'm a little nervous that the markets continue to fall, but I believe they'll start to go back up. And so some of the tools I'm using, the back spreads, I'll put a link at the end of the video, are a good way to play because I can kind of, if things go really bad on me, then I can still gain a little bit if my sentiment is bullish, and still get the upside, that I like to see. And also using straddles are just strategies that I use. They may not be right for you. Maybe you prefer to keep it in cash when things are kind of uncertain would probably be a good word. And so that's kind of where I stand personally. Now, as I look at the investor sentiment that I look at every week, people are less bullish and they're definitely more bearish. We're over 50% again on the bearish sentiment and 21.9%. And that was on Wednesday when things were going down, but today we were down as much as 450 points. So I'm guessing if they took it today, that bullish bearish number would look differently, probably getting close to 55% number of investors that are bearish now. And being a contrarian investor, I like to kind of go against the grain with regards to my, how I'm investing and how I'm trading particular stocks. So that's where we stand with regards to that. And the reason that I've come down on my sentiment, as far as I'm not quite as bullish as I was last week, is looking at the 10-year Treasury note. And we look at it for this week. We started with just a little bit over 3% on the yield, and now it's worked its way down to 3.199%, and but it was up, it touched 3.3%. So as that number goes up, I get really nervous about whether this thing's going to roll over or not, as I expect, because in order for the markets to go up, the Treasury notes will have to roll back down. Also, if we look at the DXY, which is the dollar, it has continued to strengthen. It's something I've been concerned about. I did a video on the Milkshake Theory. I'll mention it again. If you haven't watched it, make yourself aware. If this thing continues to go up, then it's going to break something. And, from a global economy standpoint, as the liquidity is sucked out of other economies. Now, again, some people are talking about 120. I'm hoping that here will start to go the other way and work its way back down as the economy gets weaker. One other mention I'll probably go ahead and make here is, we're seeing oil. It's at 86.77. That's WTI, West Texas Intermediate Crude, and that's something that is providing some of the relief. From an inflationary standpoint, you got to remember that things are getting weaker, and as they get weaker, then the expectation is a lot of these numbers will start to go in a different direction. And we look at the consumer confidence this week. It actually ticked up. So these are things that kind of work against. But no, again, nothing goes down in a straight line or up in a straight line. So we've kind of made our way down from highs of 132. If we were to look at February of 2020, we just go through these. You can see we're in a bit of a downtrend, but it's not going to just go straight down. Typically, that would not be what happens. So keep an eye on these figures. I was a little surprised that it actually ticked up. I'm not cheering for the economy. It's just to fall apart, but it is my expectation. And then we looked at the factory orders. This is another thing. It's been running nothing particularly hot, but we look at the first month that we've had where it's gone negative, where factory orders are down, and you have to. It's not necessarily a trend yet, but it's lower than it has been in a while, and we'll just have to see. Keep an eye on these numbers. To me, they're leading indicators of where the economy is headed. One of the things that did also happen today was the jobs report. We had created 315,000 jobs. I continue to expect this number to get weaker. And some of the revisions I know for the last 2 months, I think was down 170,000 jobs in aggregate for the last 2 months. So those numbers are getting worked down from, we had 526,000 jobs created in July, which was a pretty big number. But 315,000 is not bad. We did see the unemployment rate tick up to 3.7%, or more people are starting to get back into the workforce or looking for positions. And it's not a bad report. You would think, this isn't too bad. But I think as the economy weakens, as the rates go up, we'll see some things happen. And my expectation is something's going to break still. The Fed is, it's increasing 0.75 percentage point is pretty aggressive. And if they continue to do it, my expectation is that something will eventually break, and that will be the impetus for the collapse in the market, or the pause that they maybe need to do in order to see what's going on around them before they move on. U.S. labor productivity. This is one of the things that I don't know exactly how this fits in. It's one of the things that I've been trying to research a little bit, but productivity is going, as you can see, is going down, and therefore, with productivity going, I heard about quiet quitting or something like that, and how they're doing quiet firing. I think the millennials and some of the other generations are going to have been kind of pushing corporations around about what they want, and their wokeness and all that stuff. And I think some of that stuff is going to start to come to an end, and the real world's going to hit them, because this is, again, I don't hope that things collapse, but my expectation is that I'm going to be prepared if it does. And so that's kind of the picture, the economic and market picture. My commentary is going to be around kind of the contrarians that I follow. And, I did a video this past week on David Hunter. He would be a contrarian, as somebody who thinks we're going to have this end of a bull cycle, run up, melt up, and then we'll have this terrific collapse. And if it kind of fits my narrative, and I've been talking about this for a while. But he has a good track record, and he's somebody who's been around Wall Street for almost 50 years doing this stuff. So I don't know that it'll happen the way that David Hunter expects. But then you also have Peter Schiff, who was right about the great financial crisis. You can watch a video about modern day influencers, is the name of the video in the playlist. And he when everybody else was saying that he was nuts about what was going to happen in the housing market back in the great financial crisis, he was one saying, "No, this thing's going to explode." Now, I believe his expectation was that it would be much worse, but then the Fed started, quantitative easing, and so it kind of has prolonged the reckoning that is going to come, and by virtue of prolonging it, it actually has made it worse, because back then I think we had somewhere in the $8 to $12 trillion debt range. Now we have $30 trillion in debt. And so the tools that they could do is all the quantitative easing and all those types of things are what's going to lead to what I believe will be something very ugly. And the interest rate on $30 trillion in debt doesn't give the full repertoire of tools that the Fed had back in 2008 to kind of fight, the economy tanking and the bailouts and all those types of things. And so that's the expectation there. Now, if you haven't watched The Big Short, also Michael Burry, I would consider him a contrarian. And interesting enough, I'll probably do a video on both Schiff and Burry. And actually, I've got notes on Peter Schiff, but also on Michael Burry. And The Big Short is a movie, and if you haven't seen it, please see it. It kind of will help wrap your mind around how close things came to collapsing during the great financial crisis. But Michael Burry made a big bet, kind of saw what was going on in the housing crisis, that bad loans had been put out and how they got bundled. And so it kind of explains all that in a very good way. But he apparently put a big bet on a company called GEO, which is GEO, and they have something to do with like building prisons around the world. And so his expectation is, with all this, we're going to have lots of prisons built. So another depressing note, I guess. But anyway, that's my commentary. I don't know whether these guys will be right. But as I look at the theories that they put forward, especially Peter Schiff, and to some degree Michael Burry, although his is more tweets that he puts out and then he disappears and erases whatever he tweeted on Twitter. And there's no guarantee they're right, but I think it's you need to have, whether it's something that I've looked into as maybe a place to start, but I believe you got to have this investment narrative that you got to kind of, where is the puck going, so to speak, as Wayne Gretzky would say. I don't want to go where the puck is. I want to go, where it's going to be. And I think that's kind of the game of understanding, big picture, what your mindset is, and developing, an investment strategy. So, and then there's a ton of tools, which I've tried to put a few of them out there just to kind of make people aware that there's other things available that they can do that I'm sure their investment advisors don't talk to them about or tell you how dangerous they are. And they can be, but you need to, learn about them and manage your risk and do those types of things. And I'll have more videos coming up on that. And the reason I do that is because there is always a better way.